This leads us to our next segment, proposals in corporate laws and corporate finances. To introduce this, I would like to extend a warm welcome to Vinod Kothari, partner Vinod Kothari Company. Mr. Vinod Kothari is a fellow of ICSI and associate of ICAI, managing partner at Vinod Kothari Company. He's a renowned expert in company law with 33 years of experience and has authored several books on the subject. He's a frequent speaker at forums discussing various corporate law topics. Thank you very much, sir. We wish you a very warm welcome today.
Thanks a ton, Ridhimaji. Thank you very much.
Thank you, sir.
Very good evening, all of you. Thank you, Taxmann, for giving me the opportunity of being here today with all of you. And particularly thanks to all the marathoners. The marathoners have been running this race for last, 5 hours already?
So we started at 12.
I'm sorry, with 6 hours.
Yeah.
6 hours already, and are slated for another roughly about 2 hours of talking. So that requires a tremendous amount of endurance, a tremendous amount of zeal for listening to people, and that is really very, very commendable.
Thank you, sir.
Let me just give a broad overview of what I'm going to do over the next 45 minutes or so. I'll, of course, love to interact with whoever would like to interact in whichever way Taxmann takes discussions from the participants. Briefly, this is what I'm going to do. I'll talk broadly about certain provisions which are connected with corporate finances. When I say finances, I would mean the manner of raising funds by companies, whether the budget provisions will have an impact on the liability side of balance sheet of companies. That's part one. Part two, I'll talk about some specific provisions dealing with corporate laws. As such, it's a budget, and budget mostly concerned with taxation provisions, but there are some provisions which might have impact on corporate law provisions as well. So we'll discuss those. And as we proceed, we will, depending on how we progress, we'll maybe discuss a bit about the proposals on green funding or green credits, which is another very important area. And of course, certain provisions about centralization of financial information in form of a centralized registry. So that's what I'm intending to do today. And let me straight go to the agenda. So we will start with first the provisions which might impact corporate liabilities, funding by companies. And that has certain provisions dealing with issuance of bonds, debentures by companies, to an extent, payments by way of purchase of goods and services to MSMEs. And let's straight come to those, and then we talk about green credit scheme and CSR expenditure, which is obviously coming from Companies Act, but the tax provisions are impacting CSR expense as well. And then some proposals pertaining to financial sector, namely on regulators of financial sector, and then information about provisions about information repositories. I proceed straight to the capital market provisions, where one of the most outstanding provisions is a specific insertion of a section which deals with market-linked debentures. And I'm sure throughout the day, speakers might have talked about it. I'll probably be a little overlap on my part to talk about that, but I'll give maybe a slightly different perspective, because I'll talk from point of view of what is really happening in the market. And then provisions dealing with withholding tax on listed debentures. And there is a little maybe unintended miss on the part of the finance minister to not extend the provision about deduction of tax at source on offshore issuance of bonds under section 194 LC and 194 LD. That also I'll maybe briefly discuss. Let's first straight come to market-linked debentures. So I'll first give a quick background on what exactly is market-linked debentures. Market-linked debentures have mostly been issued by non-banking finance companies. In India, I'm sure people who are familiar with the bond market would agree that corporate bonds issuers mostly are financial sector entities. And of that, NBFCs are very significant issuers of bonds in India. Most of the market for issuance of bonds in India is a private placement market. Public offers do happen, but public offers are quite small, quite skeletal. Most of the bonds are privately placed. So privately placed bonds issued by non-banking finance companies. Now, the practice about market linked bonds are not unique to India. Market linked bonds or market linked debentures, they exist everywhere in the world and they prevail under various names. For example, they're sometimes called equity linked bonds or index linked bonds. They are quite common structures. Mostly they carry a principal protection feature. That is, the principal to the bondholder will anyway be repaid. Thereafter comes the coupon or the interest on the debentures. That interest or coupon is normally linked with some particular index. Market linked, but some kind of market index. The returns get linked with market index. Now you might probably get a feeling that there is some real linkage with market linked, market forces or market linked indices. For example, some MLDs, I'll use the word MLD for referring to market linked debentures. Some of you might get a feeling that the MLDs are, let's say, linked with Nifty. Some would probably say, well, it's linked with Sensex. More likely Nifty than Sensex, but well, they might be, or some are linked with rate on government securities. So they are linked generally with various parameters, various indices. However, in reality, the fixation of the rate is so done so as to almost assure a fixed rate of return to the bondholder. The the transaction is almost done on a bespoke basis, almost on a bespoke meaning on negotiated basis. Typically, there are one or two or three investors in a market-linked bond MLD issuance. The issuer is an NBFC. The investor is one or two or three. Mostly, it could be ultra net worth individuals who would like to invest. For example, let's say somebody has got 100 crores to invest over the next 2 years. Somebody is coming with 50 crores to invest over the next 18 months. So that becomes a fit case for issuing MLDs. Now, these MLDs, like I say here, normally have a tenure of 12 to 36 months. Why? Because the intention of the investor is not to block the money for a long time. Investor is looking at a medium term kind of investment option. Investor is expecting a particular coupon rate. Investor, and that coupon rate is mostly payable on redemption. Either the coupon is not there, there is a redemption premium, or even if coupon is there, the coupon is payable on redemption. That would mean during the tenure of 2 years, 1.5 years, or 36 months, there is no payment of coupon at all. The coupon is payable on redemption. So either there might be premium on redemption or the coupon itself is payable on redemption. The bonds are privately placed, like I mentioned, all most of them, most of like 90, more than 90% of the Indian bond market is privately placed market. However, the bonds are listed. Why are they taken for listing? Now, the next point that we discuss becomes quite important because the bonds are taken for, or the bonds were taken for listing for the very simple reason so as to qualify as a long-term capital asset for the purpose of capital gains taxation. So the structuring basically was that I've issued the bond, let's say for 18 months, 2 years, 24, 30 months ago, and then I issue it on private placement basis to one or two investors, take it for listing. Because it's listed, therefore it qualifies for long-term capital asset, and the return is payable on redemption. Now, I'm sure you're able to recollect that there is a CBDT circular issued several years back about zero coupon bonds. And it talks about capital gain treatment if the bonds are sold prior to maturity. So mostly what is done is the bonds are transferred to some other entity prior to maturity so that the original bondholder does not remain the bondholder. The, the, the holding of the bonds gets shifted to another entity, mostly an associated entity, and the bonds are then redeemed to the associated entity. So the game becomes quite simple. We are able to claim the entire income on the bonds as capital gain. The redemption happens to an associated entity, but in the meantime, the associated entity has acquired the bonds from the actual bondholder. The bonds are listed, but however, there is no trading in the bonds really. accepting this transfer to the group company just before redemption. As a result of that, the investor pays merely 10% tax on the bonds. 10% tax because that's the rate applicable on listed securities. Since the bonds in question are listed security, they're bonds, but nevertheless taken as securities, and they're listed, so it qualifies as a listed security. In that case, on a holding period of 1 year, unlike other assets where the holding period is 3 years, based on a holding period of 1 year only, the bonds will qualify as a listed security with only 10% tax. Now, assume the issuer issues the bonds with 10% yield. I mean, the coupon rate may not be there because the income might be going in form of a premium on redemption. But let's assume that there is a servicing rate. It may not be coupon. It may be premium on redemption. It may be coupon payable on redemption. But effectively, the XIRR or the cost of the issuance or to the investor is, say for a minute, 10%. Investor pays 10% long-term capital gain tax. He is able to therefore get a post-tax return of 9%. If I were to really do a computation of post-tax rate of return, it would probably be higher than 9 because the tax is deferred till redemption. I'm not paying tax as I earn. I'm paying tax in the ultimate year when the redemption happens. So that would further improve the post-tax rate of return of the bond. So 10% pre-tax cost in the hands of the issuer translates to roughly about 9, little more than 9% in the hands of the investor. That is the economics from a taxation perspective. Also understand that in case of listed bonds, listed debentures, there has always been an exemption from withholding tax as well. So section 193 exempts the withholding tax in case of listed bonds. So there is no withholding tax, number one. Number two, the income from the bonds gets converted into long-term capital gain with the 10% tax and just a 12-month holding period. Now, in addition to this tax benefit, there was a substantial regulatory arbitrage as well. Regulatory arbitrage meaning what? That normally speaking, when normal corporate bonds are issued, if the amount involved in the issuance is 50 crores or higher, then the issuer mandatorily has to use the electronic book building process, EBP platform, electronic book building platform of the stock exchanges. Electronic book building platform essentially is that the issuer will upload an offer document on the platform. The platform in turn gets the bids or offers from its subscribers, which are again a part of the platform. Then cutoff rate is fixed, and based on that, the allotments are typically done. Now, in case of market linked debentures, there is an exemption from having to use the electronic book building process. The EBP platform, so to say, is not mandatorily required in case of market linked debentures. Now, that makes it substantially easy for the issuer because across the table, over the counter, the issuer may agree with the investors. Supposing one or two investors come, the issuer may, in a JP, prepare the offer documents, give the offer documents to the investor. Investor puts in money, the debentures get allotted. Matter simple. There's no need to upload offer documents on a EBP platform. There's no need to wait for investors to put in bids. The entire procedural formality gets completely cut, and the issuance can happen in a jiffy. Now, this was, in addition, there is a restriction of 12 ISINs on the maturity of the debentures. This is a small benefit, not very significant benefit. This is mostly in case of very, very regular bond issuers. There is an additional 5 ISIN limit. 12 is the normal limit, plus additional 5 in case of MLDs. That's yet another benefit in case of MLDs. So MLDs were getting popular among NBFCs. And as you can see from the data that we have, it's showing there has been 16,463 crores worth of MLD issuances in April to December, just about 9 months time, 16,463 crores worth of issuance. Last year, I think for the entire year, the issuance was roughly about 12,000 crores. This year, over the 9th-month period itself, the issuance has crossed 16,463 crores. Most of the issuers are non-banking finance companies. I would just reiterate that. So this was the position so far about MLDs. They were talk of the town. They were very hotly talked about everywhere. And I just want to show some structural features of MLDs so that you realize the kind of instrument that we're talking about. These are from issuances already done. I've mentioned case 1, case 2, etc. So these are, I don't need to talk about specific issuers' names here. Case 1, for example, and all the cases here, all the 5 are non-banking finance companies. The returns in the first case is by way of premium. The tenure is 3 years. The premium obviously is payable on redemption. And the linkage here is with 10-year Government of India securities, 10-year Government of India bonds. Now, what this instrument says is that if the maturity value of the government bonds at the time of redemption, which is only 3 years away, is more than 25% of its original value, in that case, the investor will get 8.18%. And if the maturity value of the government bonds is less than 25%, in that case, the bondholder will get only the principal only. As I said, the bonds are principal protected. So the principal is anyway repaid. But the coupon or the premium redemption is missed if the maturity value of 10-year government securities drops to less than 25% of the value at the inception. Now, I'm sure all of you can realize what is the prospect of returns on government securities falling to a value of less than 25%. Unless there is a severe credit downgrade in the country, there's severe financial crisis in the country, there's a severe increase in interest rates, there's a huge debacle in the country's economy, the possibility of a over 75% depreciation in the value of government securities is nearly ruled out, which actually means what? Therefore, the bondholder will almost comfortably get 8.18% interest. Look at the second case. This one is 2.2 years linked with Nifty. And here it says if the Nifty at the maturity is less than 25% of what it was on issuance. Once again, we're talking about Nifty dropping by over 75%. Right? And once again, that is nearly 75% drop in Nifty is obviously not very likely. So basically what we're getting is that the conditions, the market conditions to which the returns in the bonds are linked are so very unlikely to happen that essentially the bondholder will still get a fixed rate. For example, you can see the case 5 is talking about 10-year government security, just a 2-year issuance. And here it's saying where the level of government security, 10-year government securities are quoting at less than 50%. Once again, 50% drop in government securities is almost unlikely to happen. So the point I'm trying to make is that while semantically, while optically, the bonds are linked with market rates like GSECs or Nifty or any other market rate for that matter. But the basic idea is to pay to the investor a fixed rate. Investor is not really wanting to take a risk on an underlying. The investor is mostly looking at getting a fixed rate. This was the position before the budget proposal came. Now the budget has completely upturned the economics of MLDs. I must once again say, remember those numbers I said, if the pre-tax return is 10%, the post-tax return with the 10% long-term capital gain tax would turn out to be little more than 9. Investor would therefore be getting more than 9% because he's paying tax ultimately on maturity. How does the budget change the equation completely? The budget now says if Irrespective of the holding period, the budget proposes to bring a new section called 50AA. Says, irrespective of the holding period, a market-linked debenture will always be taken as short-term capital asset. Though it's very rare to have market-linked debentures with more than 3 years maturity, but even if technically one was to issue a market-linked debenture with more than 36 maturity, it would still be taken as short-term capital asset. So that actually means what? Irrespective of the listing status, the market-linked debenture will nevertheless be taken as a short-term capital asset, resulting into short-term capital gain. Now, if it's a short-term capital gain, will be called upon to pay tax at the rates applicable to normal business income. It's not even a case of shares. Therefore, normal slab rate will become applicable, and the normal slab rates may range anywhere between 30 to 40%. So if the pre-tax rate of return was 10, the post-tax rate of return now drops to 6%. Now, I would just want to highlight this point. Earlier, we said 10% was working out to post-tax rate of 9%. Now we're saying the same 10% amounts to a post-tax rate of 6%. 9% becomes 6%. The ironical part in this entire exercise, and let's say hugely ironical, is that this provision does not have any grandfathering exception. The meaning of grandfathering exception is that it applies to even existing market-linked debentures, which might have already been issued and might already have been held by investors. Like I mentioned, those 16,000 crores worth of issuance already done during the year, or the issuance is already outstanding prior to that. The amended provision will apply from 1st April 2023 because it's applicable for assessment year 24-25, therefore applicable to income year 23-24. From 1st April 2023, the gains on redemption or sale of the MLDs will become chargeable to tax at normal slab rates. Now that's a huge drop, and particularly when it comes to existing issuances. Normally we say tax provisions cannot be retrospective. Tax provisions, however, quite often become retroactive. Retroactive because they affect transactions or businesses or contracts already executed. So this provision is not retrospective, but is definitely retroactive because it applies to existing issuances as well. And quite possibly, I'm sure the issuers will agitate against the provision. Some people might even be tempted to agitate in legal forums as well. And perhaps there might be a rollback of the applicability to existing issuances below. But that is something which is contentious. So without, let's say, writing on that, if currently the company has already issued market-linked debentures and they've been affected by this new provision, what options do we have? There is a provision under the issue and listing of non-convertible securities for a prior redemption of any non-convertible securities. The number one option, the company along with the investors may opt for a prior redemption. Call option may not be there actually, but based on investor request, the company may actually go for a prior redemption. That would be possible only for debentures which have been there for 12 months at least. That would mean no question of this being applicable to MLDs issued during this year. That will necessarily get caught. But if MLDs were issued more than 12 months ago, the company and the bondholders may think of prior redemption. So redeem it, let's say, before 31st March so that we don't cross 1st April 2023, the applicability date. That's one option. Second option, which is once again, that's subject to stock exchange concurrence of the stock exchanges, because this is, this is a change in structure of the bonds, and that will require the concurrence of the stock exchange. How cooperative will the stock exchanges be is something that one wouldn't know as of now, but it's possible under regulation 59 of LODR regulations to amend the structure of a bond, for which what we need basically is 75% consent of the bondholders, which I'm sure would be easy to get. approval of board of directors of and the debenture trustee, which also I guess would be easy to get. But the last point is prior approval of the exchanges. So whether exchanges will be cooperative and give the approval, that will depend on what is the view taken by the regulator. In this case, the regulator is SEBI, of course. So how do issuers work with SEBI to get this approval process streamlined? Because otherwise, exposing issuances which have already been done to a tax which takes them retrospective, in a way, the gains which would be coming after 1st April 2023 will actually be gains pertaining to previous years, because the gains it's a premium payable on redemption. So that pertains to a large part of the year, which actually is prior to 1st April 2023 as well. So tax all of that from 1st of April 2023. Actually, in a manner of speaking, it amounts to retrospective tax as well. Retroactive, definitely yes, but to an extent, retrospective as well. And therefore, SEBI may also be inclined to take a little liberal view on this, to enable companies to clean their bond books, MLD book. Now, I'm saying cleaning the MLD book is not very easy though, which is why, because liquidity issue. The issuers will have to mop up liquidity. Last quarter of the fiscal year is when the issuers need most money. Around that time, if you talk about liquidating past MLDs, where is the money? I mean, this is not the right time to go for fresh issuances. The market anyway is getting tighter towards March. So investors may anyway be jittery. Investor may not be fully cooperative. So thinking of making a fresh issue in the last quarter for the purpose of repayment of MLDs will itself be a difficulty. So this is something that is putting companies into a real tight position. Let's go to the next part, which is listed bonds. This actually, I mean, I would say I'm wondering why was this change at all needed, because the retail investment in bonds in India is anyway very small. Like I mentioned, most of the bonds in India are publicly or privately placed. You can see on the right-hand side, the graph shows the blue line is public offers and the red line is private placements. Public offers are extremely small. And if you're talking about the extent of retail investments are very small in bonds. Now, when it comes to a retail investor holding bonds, and the bonds are listed bonds, there was an exemption from withholding tax under Section 193. Now, this exemption is proposed to be withdrawn. And this also is applicable from 1st April 2023 without any grandfathering. And therefore, this also would be applicable to existing bond issuances as well. Now, as a matter of tax principle, fiscal principle, the duty of collecting taxes is on the government. The government is constantly shifting the duty of collecting taxes to the persons responsible to pay the money. Like in this case, the responsibility, instead of shifting it on instead of the government, the tax officer collecting the tax, the government is expecting the tax to be collected by the issuer company. Issuer company collects the tax and pays it to the government. Now, if the taxpayer has a tax obligation, he anyway adjusts it against his tax liability. Assuming he does not have taxable income, he claims a refund. So this situation is inequitable, because withholding tax in general is presumptive. It presumes that every recipient of the income is liable to pay tax. A lot of the so-called fixed income investors may actually not be liable to pay taxes. As per their individual taxability, they may not be liable to pay taxes at all. Now, from each of the investors, tax is deducted at source, and thereafter they either, go running for refunds, or they file a particular declaration saying my income is not chargeable to tax, etc. That is not a healthy operation of a system. So this is another provision which is again without grandfathering, and therefore that also might affect the bond market. I would talk about a third thing, which is green debt securities. Now, this green debt security, green bonds or green debt securities, Uh, Green bonds in India, in compared to other countries in the world, the volumes of green bonds in India is still much smaller. However, green bonds have been growing, and India has a framework for green bonds in terms of the issue and listing of non-convertible securities. Uh, these regulations define the end use of the money, which will qualify as green bonds. I'm sure you'll all be aware that recently the government of India also did the first issuance of green bonds on the 25th of January, to be precise. And these bonds the government was able to issue at a 6 basis points advantage over normal returns on government bonds. The issuance at a price better than the non-green price, that's called greenium. That is the premium on greenium. So government of India was able to get a 6 basis point greenium. The big point is not the greenium involved. The big point is that there is a dedicated amount of money available for green initiatives. In case of government, the green initiatives are different. In case of corporate issuers, the uses of the money for any of these renewable, sustainable energy, clean transportation, sustainable water, climate change adaptation, energy efficiency, sustainable land use, pollution prevention and control, circular economy, which obviously means things which can be recycled and can be used as inputs once again. Blue bonds, which are for sustainable water management. Yellow bonds, which are for solar energy creation. And transition bonds, which are enabling people to move to a renewable energy device based on the NDCs of the country. So these are the items which qualify a bond as a green bond. If the bond qualifies as a green bond, then SEBI has recently come up with the operational guideline of how to ensure that the green bonds are actually green. I mean, they are not what you call green washed. They're not simply washed with green. They actually are green. And that requires a continual disclosure of the actual use of the money, etc. I wouldn't want to bother you with details of this. So the fact that there is a recognition of green bonds, there is a recognition of the need for green funding in the budget as well, that is an important point. Yet another point which might impact the bond market, in at least in medium term, is the fact that withdrawal of tax deductions in case of non-unit linked insurance schemes, because the income in case of insurance policies where the premium in the aggregate was rupees 5 lakhs or above, and that will now be taxable at the time of withdrawal, at the time of maturity. And several of the so-called guaranteed returns insurance plans actually had a premium would mostly be more than rupees 5 lakhs, because mostly these were offered to high net worth individuals. But there also the exemption would be lost. That would mean the money would cease to flow into these schemes. And this money was mostly directed by the insurance companies towards the bond market. So that way, one of the sources of funding, one of the sources of input or supply of money to the bond market will also get curtailed. I'll straight come to the provisions pertaining to MSMEs and then keep some time for the CSR, which is another important point. As for MSMEs, the simple point that I just want to speak today, and there are a lot one can speak about MSMEs, but the point which is connected with the budget is the Section 43B provision. Now, Section 43B is simply disallowance of the expense. Disallowance of the expense by way of any Section 43 deduction, Section 37 deduction. That would mean anything which is claimed as an expense. Anything which is claimed as an expense for under any provision of the Income Tax Act, starting from, let's say, Section 35 until Section 37 onwards. Anything which is claimed as an expense, the section links the deductibility of the expense to the actual payment. 43B has been there for several years now, so everyone is aware. It was mostly for statutory payments, and now it's also applicable. It was applicable for interest payable to banks and financial institutions too. Now it's been extended to payments due to MSMEs as well. So if you're making a payment to an MSME, but you're not paying it within the time, the time specified in the MSME Development Act, Section 15, is 45 days. If you're not paying within 45 days, in that case, it would be allowed only on actual payment. So let's say something was due on 1st Feb 2023. You did not pay it by 31st March 2023. You've crossed 45 days and you paid it, say it's sometime in 30th April. You will not be claiming deduction in 31st March 2023. You'll be claiming deduction in the next financial year. So the deductibility will be linked with the date of payment. So far, okay. I mean, I think it's a significant disincentive to delay payments to MSMEs. But even a bigger disincentive anyway existed. The bigger disincentive was the statutory obligation to pay interest on delayed payments. MSME Development Act is not all about making timely payment. It also goes to a next level to say that if you haven't made payment to an MSME within 45 days, then you need to start paying interest at the rate which is 3 times of the bank rate to the recipient. You are mandatorily required to pay interest. In addition, when it comes to Companies Act, you need to do a filing of the dues to MSMEs too. So there are several things. Number one, interest becomes payable. Number two, you need to file the file the list of MSME delays with the registrar of companies. Number three, anyway having to report MSME dues as a part of your financial reports. So several disincentives were there already. Now, with all the disincentives being there, still, are we saying that MSME dues were being paid in time? Well, I don't think that can easily be said because in most cases, many cases, larger companies still take advantage of their overpowering position. Sometimes entities are requested to replace the bill, issue a fresh bill with a current date. So various, pressures still exist, and well, of course, one is to anyway keep client relationship in mind. So it's not as if it's law which always prevails. It's quite often the client relationship also that makes its own difference. So therefore, this provision about MSMEs is though quite a welcome move, but what we need to see is that this is actually observed by larger companies in true spirit and not merely as a way to or not merely as a legal mandate to abide by, because this is a very interesting, very important certainty of payment. Timely payment, certainty of payment is very important for the entire system. NBFCs are MSMEs are part of the very same system. And in fact, the MSME Development Act also says the invoice will be deemed accepted. Within 45 days, if you have not disputed the payment, then the invoice will be deemed accepted. Let me proceed further and straight come to the CSR provision. And I'll maybe just talk about two further things before we discuss some questions, answers. Let's first talk about CSR number one. CSR expenditure. Now, as I'm sure everyone is aware that the expenditure incurred on CSR comes from Section 135 of the Companies Act. 2% of average profits of last 3 years is supposed to be incurred by companies towards CSR, which is listed in Schedule 7, the 12 items listed in Schedule 7 of the Companies Act. The CSR expense is to be incurred on those expenditure on those items. Now, when CSR provision was inserted in the statute effective 1st April 2014, people started claiming CSR expense as a deductible expense also, as a general expense item. People used to claim it under Section 37(1), saying this is my regular business expense. CSR is not donation. CSR is not CSR is not gift. CSR is not bounty. It's an expense incurred as a part of business model. The statute requires it. In any case, every business has to be socially responsible. So it's a part of social responsibility obligation of the business. and therefore people would claim it by way of deduction under section 37(1). So first, the Income Tax Act was amended to deny the CSR expense under section 37(1). I think second provision to 37(1) was inserted to deny the income tax deductibility to an expense incurred for the purpose of CSR. That has not stopped people from claiming it under section 80G. Some people are still, I think, making a claim under section 80G as well. The other issue, however, which was though contentious, but there were various views coming from different tribunals and different advanced authority for rulings, AAR rulings. There were a couple of High Court rulings as well, was on the eligibility of CSR expenditure for the purpose of GST input tax credit. Now, this was an interesting point because assuming the company incurs a CSR expense of, let's say, 100 rupees, buying some goods or services, and the supplier of goods and services charges, let's say, 18 rupees as GST. Now, would the company be able to set off that 18 rupees against its GST output tax liability? Or the company would not be able to claim the GST liability at all? Now, one can also see that there is a repercussion of the question. If the company is able to claim rupees 18 paid as input taxes on the acquisitions done for the purpose of CSR, the actual cost of the company is only rupees 100, as we normally do in case of any actual cost of goods and services is minus GST to the extent we've been able to get a set off of GST. Some people were, however, playing over smart. They were saying that my actual cost is still 118. I have been able to get a set off of 18 rupees. That is set off. It's not a deduction from the cost I incurred. So my CSR expense is still 118. And on top of that, I would be able to claim rupees 18 as a GST set off as well. In a manner of speaking, therefore, that 18 rupees which has been taken as a credit from the government already, that was also being claimed as a CSR expense. And the rulings of different forums on this were going in different directions. For example, one can see a recent ruling of Telangana AAR. This is quite a recent ruling, Bambino Pasta. I think this is as recent as November 2022. There has been a ruling of Kerala authority which says you cannot claim ITC. The Telangana ruling says you can claim AAC, you can claim set off. There have been rulings from couple of high courts as well. There have been rulings from some of the high courts also. For example, Karnataka High Court, etc. There have been rulings of different ARs in different directions. And now what is the budget proposing with effect from 1st April 2023 once again is proposing to amend section 17/5 to say that ITC shall not be available in case of CSR expenditure. As long as the company is claiming the CSR expense as an expense for its CSR obligation, the benefit of GST set off will not be available. That's the proposed change in GST law. So the emerging position that now emerges for companies incurring CSR, and by the way, this is applicable from 1st April 2023. So that would mean the position remains as gray as it's not a clarificatory change. The position remains gray up to 31st March 2023. So depending on which AR are you covered by or which High Court are you covered by, you can still take your own position up to 31st March 2023. But from 1st April 2023, depending on the way you incur CSR expenditure, many companies these days are not incurring CSR expenses. They are not carrying CSR activities in-house, that is in the company itself. They mostly engage either implementing agencies or they make contributions to an end beneficiary. For example, say the company is contributing money to a hospital for, let's say, a construction of cancer beds. Company simply pays money. The acquisition of goods and services is done by the hospital. Or the company provides the money to an implementing agency, which in turn provides the money or goods or services to the ultimate beneficiary, say the hospital. So only if the expense is incurred by the company, situation therefore is that after this change, after the change of law, if the expense is incurred by the company, like let's say here, the company acquires the goods and services. Company pays 18 rupees by way of GST. It cannot claim set off at all. And therefore, the total costs incurred by the company is 118 only, because the company has not been able to get a set off. So the question is, the company treats rupees 118 as a part of its CSR spending. Earlier, this 18 rupees was coming from the government. Now the 18 rupees will stop coming from the government. However, as for the company is concerned, it is still a part of the aggregate CSR outgo. To my mind, the net sufferer is the CSR spending. The CSR spending actually suffers because, earlier rupees 118 worth of money was getting into the CSR activity. Now only, the company would have therefore contributed 100 rupees, claimed 18 rupees as set off, and therefore to qualify its own CSR obligations, the net spending by the company would have been higher. Now the net spending by the company, inclusive of GST, will be the target, and therefore companies will eventually spend little lesser because they'll count the GST also as a part of the CSR spending. If the money is spent through implementing agencies, the agencies are typically intermediaries. And as intermediaries, the agencies may not have a GST registration themselves. If the agency does not have a GST registration, the question of the agency claiming a GST set-off does not arise. So I will let the middle column stay as. But now most common will be the situation where the money is given by the company to the end beneficiary, say the hospital. In that case, the company pays rupees, the hospital incurs the cost of rupees 100. The hospital pays GST. The company pays rupees 100 to the hospital because the actual cost of the hospital is not 118. The actual cost is 100 because 18 rupees is coming by way of set off. So as long as the company pays 100 to the hospital, the position that was existing prior to the amendment still remains. The company pays 100 rupees, 18 rupees is claimed as deduction or set off by the hospital itself, except in cases where outputs of the beneficiary, for example, the hospital itself is exempted from GST. In that case, maybe this benefit may not be extended, but otherwise it would be possible to continue the benefit in case of direct spending, that is spending by end beneficiaries rather than through the intermediation of, rather than by the company itself. Now, other than this, I'll just maybe briefly talk about some other changes which are relevant from point of view of corporate laws. Number one, this is something which has been talked about, and I'm sure this has been discussed at length by the earlier panelists, so I will not maybe deal with that. Is 56/17B will affect investments from non-resident investors. There is a proposed simplification of KYC process and a unification of business identifier as well. PAN to be taken as one common identifier. Currently, companies have multiple identifiers. There's a SIN number, there's a GST number, there's a PAN number, there is a UID number. There are multiple identifiers for a business. So maybe a unification of identifier will perhaps help a lot. And I'll come to the last part, which is repository of financial information. This is coming from, once again, several corporate laws, partly from RBI directions, partly from CIC, SURFACI law, partly from Companies Act as well. There are multiple places where currently financial information is being filed. For example, every financial entity has to file information with CIBIL, and not just CIBIL, there are 4 credit information companies. That apart, if the loan becomes delinquent or becomes a special mention account, the information goes to CRILC. If the in addition, the information has to go to NESL also, which is information utility under IBC law. Currently, the IBBI has mandated that every default for the purpose of Section 7 and Section 9 will have to be proved as a default by IU's records, information utility records. So that also makes filing with NESL mandatory. That apart, there is a registration with SERSAI, which is required as per RBI records. If the loan is a secured loan, we need to file charges with ROC as well. If the charge is on immovable property, we need to file it with the land registry also. Multiple registrations under multiple laws. initially when the SURFACE Act was enacted, the idea was that there will be a unified registration, because that is exactly what Section 23 of the SURFACE Act talked about. It talked about a unified, integrated registry system. But unfortunately, that unification never happened, and we have continued to live with multiple registrations under multiple statutes. So maybe now the government is proposing to have a single window registration. It says that there will be a statute to provide for it. I don't know what statute, separate statute, or maybe Section 23 of SURFACE Act will get amended. I'm not sure on that. But that's another proposal, which is, of course, extremely welcome. But we are hoping that this will not be one more registry. It would probably be one registry which is serving for all the registries. Ridhima, I'm almost done with my time, so please do let me know if I need to be here.
Properly on time, sir, I must say. So we do have some questions. I'll read it out for you. One second. Sir, one question which is coming up is, Finance Bill 2023 brought an amendment in Section 18A of SCRA. Now the offshore derivatives will be legal and valid contracts. How this will impact foreign investment in India?
So this is mostly for IFSC entity. IFSC was intended to be, I mean, India's bridge between the financial markets of the world.
Right.
So the whole idea was to bring and encourage trades in offshore derivatives to be done through IFSC. And therefore, the government has clarified the position that was prevailing earlier. Earlier, there was a confusion about whether offshore derivative. IFSC is, though, from FEMA perspective, not a part of India, but from income tax perspective, it is a part of India. It's India when it comes to income tax. It's not India when it comes to FEMA. So therefore, Income Tax Act still applies to IFSC. And hence, the provision is directly intended to enable offshore derivatives to be transacted through IFSC.
Interesting. Next question coming up is GAR provisions are not applicable to existing MLD?
GAR would be, I mean, yeah, one could argue that if the substance over form theory be applied to MLDs, one could probably challenge them, saying that the substance was one of earning income. But GAR applies only after a threshold level, number one. Number two, GAR has a complicated process of first referring it to a determination person, then that also becomes challengeable. I mean, you are right that perhaps the tax officer could have challenged it based on the substance, but that would have been a case-by-case attack. Here, it's a generic, I mean, amendment of the statute, which is killed the arbitrage for MLDs altogether.
Interesting. So can I take one more? Sir, transferring IFSC via LRS, then TDS at 20% will be applicable. Is it correct?
Transfers via IFSC. I'm not sure on this, Ridhima. I'm not
There's
sure.
still a very debatable thing going on.
Not sure on this.
No worries. Next question we have on our another platform is, the finance minister proposed setting up an IT-enabled IEPFA portal. Will this ease the processing of investors' claim?
Hopefully, because currently, once the shares and the dividends go to IPF, drawing it back is Herculean task. And there are enormous number of regions for which the claims get rejected. Sometimes because it has to go back to the company. I mean, getting it back is a tremendous task, and normally it's all done by mediators, which is what is not the right way of running the system. So yes, if the idea of a unified IPF withdrawal mechanism gets I think it's a wonderful thing to happen.
Perfect, sir. Perfect, sir. Thank you so much, sir.
Right.
It was a very, I must say, a very needful insight, and thank you for a thorough analysis on the topics.
Thanks, Atan.
Thanks a lot, sir.